Okay, why don't we kick it off? So, real excited to turn it over to Ryan and Bryan to enlighten us on this private money and investor financing in this new COVID-19 world. So, why don't you guys take it away?
Sure. Thanks, Smarty. Thanks everybody for having us. We appreciate the time tonight, and we appreciate the opportunity to be on here with you and to collaborate with some of the other lenders on here. Don's got a lot of wisdom, and so I'm sure his thoughts will be valuable to the group as well. So I'm Ryan Herting. I'm one of the co-founders of IFundPhilly, now being rebranded as IFundCities as we expand out of Philadelphia. We are an institutional-based private lender. So what that means is our capital stack's designed similar to hard money, but also has some institutional takeouts. We keep some of our paper on the balance sheet. We sell some of our loans to Wall Street, but retain the servicing and asset management of them. We stayed in business through COVID because we had a diversified capital stack of both kind of local fund management, big family offices, local banks, and institutions. So we're very diversified, which gives us flexibility in both rate and pricing. It also allows us the ability to put stuff on our balance sheet when credit markets tighten up, like we saw during COVID. Bryan's our co-founder. He spent, I won't steal his thunder, but I'll give you a little snapshot. He's really the brains behind the operations. I spend most of my time client-facing, running the sales. Bryan has 15 years of structured finance. Spent a lot of time on the street and credit boxes, kind of everything mortgage soup to nuts. And so he spends a lot of time. We've coined him the loan doctor. So he spends a lot of time structuring loans and putting the pieces together behind the scenes. So with further ado, I'll kind of give it over to Bryan, and then we can jump into the presentation.
Thanks, Ryan. I think you summed it up. You summed it up well. So Bryan Ziegenfuse, like Ryan mentioned, we co-founded IFundPhilly, and now as we've expanded out beyond Philadelphia, the name doesn't carry as well in certain geographies like some of the southern states, even as close as Pittsburgh. So we had to come up with a rebranding, and that's the IFundCities. And so as Ryan mentioned, I really kind of help run more of some of our institutional relationships, our balance sheet kind of management, in order to continue to provide liquidity to provide loans out to investors. And so I've had the pleasure. So I spent 15 years more in the residential mortgage space, and which is, think of it as your traditional Fannie, Freddie, conventional loans. And one of the common themes, so I spent a lot of time down in CC actually working with Fannie and Freddie and Ginnie Mae, part of HUD. And one of the concerns was always housing supply. And one of this is, a prime area where a sector of the market, all of you on this call, is providing more and more housing supply out in the market. I had looked at this type of business a couple of years ago, was super interesting. And, so we spend all of our day trying to provide capital out to real estate investors like some of you all on this phone, because we know that you're solving a major problem in the country, which is a lack of housing supply. And so turning things over, taking places from single families to duplexes to triplexes, just increasing and improving the housing stock in some of these distressed areas is an ongoing thing. So super excited. And I think we've got a lot of positive momentum, hopefully, coming out of COVID here.
So we won't bore you guys to death with the PowerPoint, but we do have a couple slides that we think illustrates kind of pre-COVID, post-COVID, how we view the world from a lending perspective. And then we're happy to field Q&A. And Don, feel free to chime in if you're seeing things different than we are right now. Or Steve, I know you're doing your first loan, but you've been actively looking at it. And so with that being said, we'll kind of jump into the landscape. Bryan, I'll let you drive, and then I'm happy to chime in there.
Yeah. So here's some of the better looking guys on the team that we put in there from our office. Here's the here's the collective team at this point, and we did just bring on a 6-person here But I thought, what we do is when we go through the private lending space, and I know everybody's more, thinking about, what's it like kind of now that we're coming out of this COVID. But just to take a step back, the private lending world in how we articulate it to our investors and even our customers and others, we think of it as, you've got, we are focused on providing working capital to real estate investors. And so we carve it up into kind of three segments of the market. There's the traditional kind of hard money lenders who serve a certain need for real estate investors or business owners. There's the community banks that provide, a lot of working capital to real estate investors and businesses, and then the third group is the private lenders. Each of them serving their own kind of unique need and niches. And so the easiest way to kind of go through those, on the hard money side, you've got, it's a somewhat, we consider it somewhat fragmented. It's very local. So the hard money, they're more comfortable sometimes going up higher on leverage than on some properties. They might not look at credit scores as much, or they might, not look at certain credit events, whether it's foreclosures or bankruptcies, or they might provide more leverage, like I mentioned. And so there's a whole host of reasons, and they have more local relationships. It's super customizable with some of those relationships because they know who you are. You might live in the same neighborhood. It could be a very, very kind of peer-to-peer type of lending. The community banks are the first Colonials of the world, the Hyperions, some of the credit unions that are 100% focused on serving their local communities. And, they sometimes will, they have a little bit more latitude than some of the Wells Fargos, the Bank of Americas. For examples, a lot of times we'll talk to the Wells Fargos of the world, and they won't touch investment real estate, or especially construction real estate, where the loan amount's less than, say, $1 million or a few $1 million. And so the community banks definitely serve a big need in supporting real estate investors, especially on refinancing out your projects into permanent loans, is an ongoing niche that they fill. And then you have private lenders, and private lending has sits largely in between these areas, really focused on real estate investors that have experience, that are focused on a few niches. That might be building single family homes, that might be renovating, fixing and flipping properties, that might be repositioning 1 to 10 unit type small multifamily type of properties. They're really focused on providing working capital towards real estate investors that support that whole mission, largely supporting the mission of increasing the housing supply. And as this market has evolved, there's become more and more larger private equity type institutions, or asset managers. Think of private pension funds, endowments, insurance, investment vehicles that like the yield. They realize that there's a prudent approach, and there's just lower delinquencies, less kind of credit risk than going out further on the credit spectrum. And so this market has really evolved over the last largely since about 2012, 13, 14, has continued to come into play in the private lender space.
So Bryan, before you jump there, I think some of our best borrowers utilize all three of these buckets, right? Larger construction projects go to community banks. fast closes, guys that, need quick money, go to hard money. They don't care about the rate. Maybe they can execute pretty quick, or they want to use that bucket, fast and furious, 24-hour close, or underwriting the deal only. They don't have all this documentation that needs to be created. And then maybe some of those more experienced guys that want a little bit less on rate but don't want the red tape of the bank would come to a private lender like us. You might get a little better leverage and rate in terms of, for the overall structure of the deal, but we can move faster, and we typically have big coffers. And so we're reliable in funding sources like COVID. So I think all our investors utilize all three of these buckets really well, depending on where they're at in their life cycle of investing. There's a need for all three.
Yep. All right. So COVID hits, liquidity almost instantaneously dries up. So I talk about the private lending space. It's backed by banks and larger institutions. And so when COVID hit, it was pretty much a 2-week period of time where there was just a chain reaction where everything kind of froze, and the cap, you could call it the capital markets weren't trading. And so you had a run rate of a few $1 billion a month of volume that just came to zero. And so, any prudent lender, had to reevaluate the risk. And so, we just like anybody, we took a look at, okay, what are some of the impacts of the loans that were long on our balance sheet? What are going to be some of the impacts of COVID? And so, and the market generally hates the word uncertainty. And so there's all the uncertainty, how long's COVID going to last? What's it going to do to unemployment? What's the government going to come out with some stimulus? Why am I going to buy private lending bonds or private lending loans when I can buy something else that's trading at a discount? And so all these things needed to clear. And it started pretty quickly. I mean, it's been amazing. I mean, the Fed did some quick actions quickly after the markets froze, and you saw repo rates, repurchase rates skyrocket, and which is just short-term funding. As those things skyrocketed, the Fed came in, a lot of purchases, and really over the next couple, weeks to month, things started to normalize pretty quickly. And so what, all of this uncertainty has done has really done just, the risk spectrum has been repriced. And so in the private lending world, you had interest rates that were, low 8%, 9% was a lot of the interest rates that were being pushed out. Higher leverage points. So the loan to value was 70, even upwards of 75%. And now we're seeing, what we believe there was pretty aggressive interest rates of where things were at that point for the actual risk, because these are distressed properties. They need to be fixed up. And so the post-COVID world, what we're seeing now is, interest rates probably about 2 or 3% higher than when they were pre-COVID. The leverage is about 5%-ish, I'd call it at this point, difference. So you're bringing about 5% of the deal more to the table, and your interest rate, like I said, your interest rates are a few points higher. And they are, the experience, as I mentioned prior to this, the experience on the private lending side is important. It shows a commitment to the business. It shows, you've got to make mistakes. We made mistakes as a business starting out, and you got to make some of those mistakes. And so usually by the time you get on that second project, that third project, your execution timeline gets better. You're sourcing better deals. You're managing your contractors much more efficiently, and so that helps minimize our risk. And so that's where we're, getting to that second project is a big hurdle for us.
Yep.
So when you talk about private money versus hard money, I mean, this is a great example. I mean, we were one of the only private lenders left in the market, including the big boys, the Lima Ones of the world, the Finance of Americas of the world. And that's because we had diversified capital stack, but that's where having a relationship with an IFundPhilly and a Don or a Steve would make sense because they got their own private money, private funds. They could continue to fund through COVID like we did. On our side, a lot of the institutional lenders that didn't have a balance sheet like we did went out of business. So you had glorified brokers with a couple bucks being table funded by these large private equity groups on Wall Street. What COVID has done is kind of cleaned out that noise. We call it the cleansing. And so now you have guys that are real lenders, lending their own money, having their own funds, managing, being stewards of capital, out providing working capital still left in the market. And so the rates that we're showing on this page are indicative of private lending. Hard money rates are still, at least what we see in the market are somewhere between that 12 and 14%, 3 to 5 points. But again, there's a lot of benefits to that. If you can execute fast and you need money quick, that's a great outlet. And again, they can be creative in their structuring as well. So I want to make sure that everybody understands that this is more private lending centric than it is hard money lending.
Any Smarty, what's usually the cadence on questions?
Yeah.
Do you wait till the end or you're on mute?
I think with a smaller, intimate group here, why don't we just, if you're okay, why don't we just throw questions along the way instead of throwing them at the end? So I know, Holly, you're big. You have a lot of projects going on right now. Do you have any specific questions on what you're seeing and the kind of money that you're looking for? Putting Holly on the spot.
Holly might have a term sheet from us that's kind of indicative of what these rates look like on two of her projects. I think we're online, Holly.
Yeah, I do have the term sheet. So I mean, yeah, no, I don't have too many questions. The main questions I have, like on the buy and hold stuff for the asset lenders, is on the refi, and that's just not this. That's not this program.
So most private lenders, I mean, we were doing 30-year fixed, we were doing all the hold investing too, which were, somewhere between, maybe 6-7% fixed for 5, 7 or 30, all the way out to 30 years, type of loans. I expect those to come, we're seeing those start to come back I expect us within about 90 days to have what I'll call a rental product. That's what we call it, a rental product, a rental program, back out. It won't be, I don't know where we'll be in that time period. I think it'll be largely depend on how how well essentially your tenants are paying across the space. How does employment come back? We've talked to a lot of our customers, and they're just, the unpayment rate or whatever you want, the delinquency rate or the default rate of their actual underlying tenants is insanely low. We have our geography. Most of our stuff is in the Pennsylvania area, South Jersey, and we're starting to expand into Maryland more as far as rental loans. And so those geographies seem like they're performing really well. And, there might be some outliers with areas like maybe in Orlando, very travel-based geography or tourism-based geography. That might take longer. There might be some more longer-term issues there, but the geography here seems pretty strong. I don't know what everybody's seeing on this call, but I expect that product to be coming back more and more. I expect that more. And today we're, community banks are still, and credit unions, they are, even though they might be a 2-month process.
They're so painful.
Yeah, they are. And Holly, as I told you on the phone, and for the rest of the group, there are a handful of local banks that have vetted our underwriting guidelines, and we can help. We can still help investors, especially in Philadelphia, Greater Philadelphia, get exit financing pretty consistently. So if we're underwriting the front half of the loan, we can share those with our local community bank sponsors, and we can get you out of most of the deals if they're good deals.
That's awesome. Because we haven't had any issues with any of our tenants through this. Well,
That's
one.
good.
But I mean, he still paid. He just paid less. So
Yeah, and that's consistent, Holly. We last month in our meetup, we did a poll. We had probably about 30 or 40 people on, and in the poll, it was surprising how few of the landlords out there were raising their hand and answering that they had delinquent tenants, that they were still paying at the end of May, in the May timeframe. So, I've been hearing the same kind of thing, Brian, is our region is, people are paying. They may not be paying the same amount. They may be paying a little late, but they're holding sound.
yeah, no, we did good. So
This is Beth. When you talk, I wasn't on the meeting last month, and that's a shame, but when you talk to folks, because of course I see the delinquencies because they call me when there's delinquencies. But when you talk to folks who are having good experience with payments, is this, kind of upper level rentals, or including lower, when I say upper level, more expensive rentals versus low cost rentals? Is there better experience with folks that have rentals where they're higher cost rentals versus the lower cost, or that really hasn't been something that people are asking questions about?
The cost structure didn't really come out in the last survey last month,
Yeah.
but right now in the comments, like John just put a comment for everybody. His 4 units are paying full rent. He's knocking on wood, but John, you wouldn't classify your properties as high end rent districts, would you?
No, I have a unit in Pottstown that gets 1,100. Norristown I get 1,500, and 2 in Downingtown 1,500 and 1,100.
That's
So.
good. And then Rich just made a comment. If everybody saw it, he talked to a large developer that has less than 2% delinquencies on 500 doors, which is good.
And the other thing I'm curious about is, because I have heard from some of and this is kind of going off topic, so I'll just say this. I've heard from some of my clients that they have folks that were laid off, but they're getting paid under the PPP. And the question is, when those payments run out, because they were getting paid, for what it was at 2 months, do the delinquencies start going up?
Yeah, it's going to be an interesting dynamic to watch out for.
Yeah, so this is Don. I have a couple of comments in response to, I'm not sure whose question, but the rental question. The data, excuse me, the data that I've seen is that Beth, nationally, about 8 to 9%, this is last month's data, I haven't seen this month's data, 8 to 9% of renters have not paid their rent, which is considered much less than what was expected. And the answer to your question about the segmentation about lower rentals versus higher, or lower rents versus higher rents, if I were to guess, I would say it's proportional to the number of people that are unemployed. And I think I'm not sure, I think it's like 60% of the unemployed folks are, let's say, I think less than $60,000 a year in income. And I'm not sure how it breaks out above that. But so I think generally the lower people that earn less money are more likely to be unemployed and are more likely to have trouble paying rent. And when the government payouts start to wane, and I can't follow what's going on politically, but there's a lot of talk about that, I think you'll see more rental defaults than you're seeing now.
Yeah, and what you're talking about goes exactly along the lines of this is Beth Stern Fleming, and like I said, what you're talking about goes exactly along the lines of what I'm seeing, that the lower cost rentals have a higher incidence of default than the higher cost rentals. And I agree that I think it's exactly because those are the folks that are unemployed. Although I will tell you that there are certainly tenants who are just taking advantage of the fact that there's no evictions. And so they say, I'm not paying because I know I won't be thrown out. But I do believe that that's a small percentage.
Yeah, you're exactly right. And I've been following the the answer line. And when can evictions begin again? Sometime in July?
July 10th, right now, again, this is Beth Stern Fleming. So right now in Pennsylvania, the date is July 10th. And I put on the dig answer line kind of what the counties, well, what Philadelphia, Montgomery, and Bucks County are doing in terms of scheduling evictions, which, we can talk offline about that. I don't want to mess up the presentation, which is on a different topic. We just got kind of involved in this topic because it's related to the rentals.
You're fine, Beth. You guys can get me. It all goes hand in hand. It's all real.
Goes hand in hand. Yeah.
Yeah. So right now we don't know if there's going to be an extension of that July 10th date. The courts are acting as if there's not going to be an extension because they are preparing to hear eviction cases. But nobody knows if there will be an extension to that date. And what's happening is there's a group of eviction cases that were already filed prior to the COVID, but never got heard in front of a judge. And those cases are going to go first. And then new cases will go. So some of the counties are saying, we're not going to be able to schedule the new eviction cases until September or the end of, and nobody knows how many cases are going to get filed and therefore how long it's going to take to hear those cases. So if you've got an eviction case, you need to file it as soon after July because they're going to take these cases first come, first serve. So the new cases can't be filed until, like I said, after July 10th. You need to file them sooner rather than later.
But where the thread of this discussion fits into the lending story is that as a lender who's going to do a refi against apartments that have renters in them, there's a much higher risk of not having the cash flow to cover the cost of the loan in the next 2, 3, 6, 9 months or so than there was in the past. So a question to Bryan and Ryan is, how do you mitigate against doing a refi loan against an apartment or either a single or multi-unit apartment when there's more of a chance in the future of having less rent receipts than there was in the past? How's that handled?
Brian.
Yeah. So there's the way we look at it is through reserves, how much cash a particular borrower might have after the loan is closed in order to weather that uncertainty if they have to go through an eviction type process in say it's a 6-month process. We typically look for somewhere in the neighborhood of 6 months of payment reserves on a particular loan. It could be 3 months, but somewhere in 3 to 6 months is how we might look at some of that risk, or we might reduce the leverage on certain markets or certain types of products. We might, instead of going up to 70% of the loan to value for 1 to 4 unit rental property, it might be 65% or 60%, depending upon that.
Don, how would you handle that?
I'm sorry, who asked that question?
Ryan asked, how would you handle it, Don?
Oh, well, first, okay. Well, basically, same thing. I would, my loan to value would be lower, and I would like to either have reserves. That would be my second choice. My first choice would be some other source of collateral.
Yep. We're in agreement.
So what Brian was saying, having that extra collateral to
Yeah.
weather the storm.
We do a lot of cross collateral loans.
Because in this business, the axiom "shit happens," definitely fits.
Absolutely.
So Holly was asking, they have properties that are free and clear. Would those be looked at as well? As part of the collateral, absolutely, right?
Yeah, we actually do that. We do a lot of that today where somebody's, we talk about the need to bring a little bit more capital to the table. And so that extra 5%. And so we have borrowers that they own a property, say they own a property free and clear, or they own land free and clear. We use that essentially as the down payment of the loan. And they're able to not bring any cash to the table.
And Holly was saying, is that for collateral and reserves?
That's a good question. I haven't gotten there. We would actually, we do look, so a lot of our deals, we don't have that interest reserve. We can do it. I mean, it's very common that we do. We work with the borrower of whatever's more advantageous. Sometimes they just like not having to worry about a monthly payment. We could fund the interest. We're going to make sure that there's the ability to make that monthly interest payment for, at least 6 months kind of thing. There's ways we can get around that and fund that. So in that example, like say you had a property that you want to cross collateralize, we could just fund the interest reserve by, some amount of that cross collateralized property. That makes sense? Can't see the chat.
Well, the goal, of course, is that everybody comes out of this hole and that the borrower continues to make money. And, we do everything possible to make sure that that happens. These are very unusual times, and the goal is to work closely with the borrower to make everything work.
Yeah, communication is key, but also creative finance is key, Don. I mean, you touched on three different ways to be creative, and I think, the ability to be creative and work with a borrower to structure a deal that makes sense to get them through is paramount during these times.
Very good. Well, Brian, I like this next slide, creating opportunity.
Yeah. I mean, this is what it comes. This is what real estate investing is all about. You've got, I misspelled that second bullet point there, but uncertainty creates opportunity. I love this because I feel like I feel like we actually are, what we've done during COVID is very, I'm super excited in the direction of our company. And it was a function of us as a team staying focused, not watching, the news cycles or being out on social media too much besides marketing, and really staying focused on what we needed to do in order to be successful in our space. It's been, so the way I see this, even with, our customers that are still coming to us day in, not day in and day out, but month in, month out on new deals that they have, is they're, we've been meeting with them proactively. We've been, here's where we think the market's at. They've had the opportunity to negotiate some better deals because the financing cost has gone a little bit higher. You could argue that the sales prices actually have gone higher, which I wouldn't have told them 2 months ago, but sales prices seem ridiculously strong as supply doesn't exist. But there's going to be more and more opportunities for, everybody on this line here, on this call here, to take advantage, because there's going to be changes as a result of this COVID and some of the other, some of these things. There's going to be more distressed sales that are going to come online as the pipeline kind of works through some of these. There's just going to be people that overextended themselves. There's just going to be some things that happen. There could be changes in how people work. There could be changes in how people live or where people live. And so, as a real estate investor, staying on top of these changes, being a leader in some of these changes, staying core to your market, staying core to, executing. There's going to be, I think there's a ton of opportunity. The housing supply, the last thing here that that gets me up every morning, as Ryan knows, and keeps me going, is the fundamentals of this overall this business. When I think about real estate investing in the 1 to 10 unit range, is there's not enough supply out there, and you're not going to have people still aren't going to live in the middle of, they're just not going to live in the middle of nowhere. And if you want to live in a town or areas, maybe you don't live in the dense center city, but you live in some towns, you want walkability, you want restaurants, someday you're going to want restaurants. I know my wife wants a restaurant right now. Yeah. And so there's those houses, those areas are going to need, people are going to rent, people are going to be, there's just a tremendous amount of opportunity where you're not going to have Toll Brothers coming in and knocking down developments. It's just not going to happen. So it creates a lot of value and a lot of opportunity for everybody on this call that continues to invest.
Yeah, I mean, I'll just add real quick. Household formations continue to outpace supply in a drastic measure. So you already had the beginning of this year starts down, new permits down. They're now further down because of COVID. There's still good. That's gonna further fuel the lack of supply. Household formations are still outpacing supply. So we are extremely bullish on the asset class. As Brian was saying, we often don't let him talk on these things because he's better structuring. We love him, but but yeah, so we like the supply, we like the asset class. In particularly, in 2008, Philadelphia's ARVs didn't drop, but 15%. We aren't seeing that. We're seeing appraisals come back strong in Philadelphia and the greater Philadelphia area, and so that's all good signs. And like Brian said, ARVs are actually rising. I'm not sure I agree with that, and we're looking closely at deals and the fundamentals of the deals, but. Overall, we think there's a healthy market still to continue to support real estate investors, working capital, and move forward. So open up for any questions. We didn't want to overwhelm you with a bunch of PowerPoints. The other two slides we skipped over were a bit redundant to the one we showed you. Just kind of laid out some of the market, kind of pre and post, who some of the players are in the market, why you would use the different, segments of money. If you guys want to talk further about it, we're happy to jump into it. But why don't we open up for questions? Any questions on anything lending that we could answer for you guys?
Yeah, there's a couple in the chat. I'll highlight. Redwin was asking, when we're talking about the supply of house, how that goes. Why does everyone think the big builders will not step in and build more, since money's so cheap and they can borrow and build more houses?
Yeah, let me answer that. I mean, I think of that as like, why? I mean, the money's as cheap as it's going to most likely get for these, for the big builders, unless they're building towns and it's more, of a community feel. I don't see, There will, they're going to continue to do, certain areas, especially in the southeast part of the country where you have larger land. Maybe there's opportunities to do it. But if you look at the areas in and around, like use Philadelphia as an example, you're just not seeing develop. I mean, at least I'm not, seeing populations move into large development homes. It feels like, towns, the theme around walkability, the Phoenixvilles of the world, the Pottstowns, the some of the towns along the main line that have a core town or anchor. Even like, I mean, I guess, you could use King of Prussia as a great example. Where they came, large builder came in and they're building a nice area. Off of that, I think those will continue as a good kind of template to use. But there's just so many areas around the Jenkintowns, the other areas that feed off the train lines that you can feed into the city. You might not live in Center City, but you'd like to get to Center City to go to the restaurants and some of the other aspects of the city, art museum area and whatnot. Those themes to me just don't seem like they're changing. And so you're not going to have the Toll Brothers come in and build wipe out a development and acquire a bunch of single family houses and then wipe it out and try and go do something. It doesn't appear to me that they're going to be that's just not what it just doesn't appear to be. They're going to focus on larger track things, maybe in Texas and other areas.
That being said, I mean, we see a lot of our borrowers do really well. Big developer plops a nice piece like King of Prussia, and then everybody fills in and around, right? So you got the marquee buildings, and you got the small real estate developers that are fitting the infill around that. I mean, that's a continuing. The big boys are going to set trends. They're going to continue to set trends, whether that be here locally or whether that be in more rural areas where they can grab more land or more pieces and aggregate and do larger tract home development. But either way, larger developers are still going to play the game, and the infill development around them is continuing to be vibrant in Philadelphia from our perspective.
I have an addition to those last comments. I think in normal times, the majority of homes on the market are pre-owned. I'm not sure what the percentage at any given time of homes are new construction, but I think it's well less than 50% for sure. And the reason we're having a limited supply of pre-owned homes in the COVID times is I think people don't want other people walking through their home, at least not now. When things loosen up or when the virus is behind us, whenever that is, I think that'll, that balance will change. But I think that's the answer to the question about why are not big builders continuing to build. I don't know for sure, but I suspect that they are continuing to build. And the reason for the limited inventory is because of less pre-owned homes on the market for the reasons that I just mentioned. If any of the real estate agents are on the line would like to comment on that, I think we would appreciate it.
Well, no, the one, Holly may have some thoughts on it, her being an agent. She commented that, with the limited supply, she's getting multiple offers on her deals.
Exactly.
And well past 30K over the asking price. So it's just a function of, limited supply and demand, right?
Well, there's fewer, the demand is greater than the supply right now, right, for the reasons that I mentioned.
Yep.
But I don't know that new home builders have stopped their building. Unless somebody knows otherwise.
Yeah.
No, I think if you look at some of the statistics, new starts and new permits in many metropolitan areas are down, Don. But I would agree with you that they haven't stopped building. I don't think they're going to stop building. But I do think COVID's going to further slow and delay new starts. Yeah. And that's going to further put pressure on the supply-demand equation that we continue to talk about.
Yeah. We have another question from Nikia, and I guess it goes all the money guys here on the call. So Steve, Don, and Brian and Ryan. She's a first-time investor. So what's a good contingent type of investment that she could pursue, and how much cash as an individual should she have on hand, being a first-time investor? What are some of her options that you see out there?
Yeah, so I'm happy to tackle that. So newbie investors was one of the segments we really focused on prior to COVID. Our capital constraints behind us, we've moved away from servicing some of the newbie investors. So we're directing them, if they have cash, they have good W-2s, they're bankable clients, they're not worried about speed of execution, we're directing them towards local banks. If they don't have a lot of cash in hand and if speed is of the essence, we're directing them more to guys like Don and Steve that can help them. We do a mentorship program. We can help them, build their project in Philadelphia if that's something of interest. I know, Don, I think I heard you talk about that, and you maybe do some of those types of programs in the burbs. But I would say if you're a newbie investor, you'd want to look at all of us, right? You'd want to talk to every single one of us, see what all of us can put forth, where we'd be, leverage our networks. And at the end of the day, we're here to add value to borrowers. And so sometimes that's connecting them to other individuals, and sometimes that's connecting them to local banks, and sometimes that's providing good contractors. So, my suggestion to any newbie investor on here is you touch base with all three of us and everybody on this call and try to learn and build your network and expand, and all of us, I'm sure, can provide value to you in some way.
That's a good answer there, Ryan. Looking down, do we have any? Oh, Redwin has another one. How does the Zillows and Redfins coming in as flippers impact private money lending?
They're a pain in my butt now. So I think Bryan touched on this, local. We see there's a bit of a fragmented industry. So you have, let's just take Philadelphia as a market because everybody knows it pretty well. In Philly, you got a handful of what I'll call local lenders with $10 to $15 million funds. And then you got, some institutional players like a Spring Garden, ourselves, that kind of play in the market. Redfin and Zillow are making it tougher. They suspended their programs during COVID, but they're buying. They have the data, so they're using their data at the end of the day to become iBuyers and buy and gobble up a lot of properties. And they're partnering with these large institutions, the Torax, the lending ones, the lending homes, the KKRs, the Goldman Sachs, Genesis Capital, all these types of guys to leverage their funding. And so, they are competition to the flippers out there. We're not seeing compression on rates from our perspective. If you do participate with those types of guys, that volume, rates are going to be, you're going to bet on volume versus, making a spread, with rates and points. So I don't know if I answered your question, your question, but that's what we see. They're active. They've been on hold. They're going to be active. They're using their data. They got a leg up on everybody else because of their data, and everybody uses their platform. Smarty actually might be one who can comment on this because he looks at a lot of this technology and how to use tech to acquire properties.
Yep, that's good. Holly made a great comment. They're a pain in everybody's butt. And as an agent, Holly, we all know, but this estimate said my house is worth this. Yeah.
So I have a question to Redwin, if you can hear me. So the Zillow and the Redfin and others who claim they buy the house from the seller, they still have to turn it. They don't keep the house. They need to, if it's a distressed property, they still have to sell it to a flipper or somebody that's going to take it on and renovate it and ultimately sell it. So my question is, what's that process look like? And the second question is, when they sell the house to the flipper, do they require the flipper to use their financing, or can the flipper bring their own financing to the table if they buy a distressed property from Zillow or Redfin after they did the purchase from the seller? Can somebody explain that more thoroughly to me?
Do you have any background on the Zillow acquisitions, Ryan?
I don't. I would assume they have strategic partnerships like a New Western, right? With Sherman Ridge, type of relationship where they're wholesaling and they're using their own money. But I can't really speak to it, so that would be an assumption. So please don't quote me.
So I was on a call with Zillow today with my brokerage. So they don't have their iBuying set up yet in the Philadelphia area, but they're looking to do that, and they want to move into this area as a whole. But it was my understanding from the conversation that they buy the houses so that they can make a profit They did not say that they will not renovate them. What they're doing is they are grooming a bunch of agents that advertise on Zillow and pay them money to go into a flex program so that as they buy up these homes with the iBuy, they can give these agents the listings to sell them.
But
So-
somebody has to do the work.
Right.
Yeah, they'll do the work. But Don, I could speak my brokerage. We actually just opened up Pennsylvania. We're now in 48 of the 50 states. And our platform, we see Zillow and Redfin as our competition, but we do it a different way. They have a single pony to ride on, where, as you know, with our Express Offers platform, we have now over 600 iBuyers on that platform. So, for example, here in Pennsylvania, I have one iBuyer. It's an investor that is the single largest customer of Home Depot. They did over 6,000 flips last year in 2019. 6,000 flips.
Wow.
So when they come into Philly, they are doing the work. And what Holly was just saying, the whole arrangement is if we find a house that's distressed and put it on Express Offers platform, they're going to take that house, gobble it up. They're going to make it the pretty house on the neighborhood. And then they flip the listing back to the agent to put it on the market, for retail. So, a lot of these big players are coming into the market. So, I see that, the Zillows and stuff, they are competition because they are trying to make that spread and make a profit on that acquisition, whether it's a Zillow or it's an Express Offers iBuyer that's coming into the market to make that buy.
But aren't those distressed properties being made available to flippers, or is this one company that you just mentioned flipping 100% of the available distressed properties?
They flip 100%. They don't try to sell it off to another investor to flip it.
No, 100% of all of the available distressed properties. That can't possibly be the case.
No, the ones that they're pursuing, they don't acquire a property and then give it to a flipper to do the flip.
Right. So what percentage of the total available distressed properties does that company handle?
Oh, well, 6,000 I don't know what the total number of flips were in the United States, but 6,000 is a pretty big number. So, they're the largest flipper in the United States. So from a percentage wise, and they're newer to Philadelphia, so it's not like in Philly, they dominate the Philly market yet, because they just opened up Philadelphia right before the virus. They opened up in February. So they've already, I know since they opened up in February, they did 65 flips in Philadelphia. So, and just since February. So they are in the city right now. They're in our region and they're coming in strong. They see this as a strong region that they want to perform in. But they're just one of 600 iBuyers on the Express Offers platform. So I put a house on there about 2 months ago when it first came on, and I had 9 offers from iBuyers that were giving me all kinds of numbers for that deal. So it's a new game. The iBuyer market is strong, and it's a new game. I know Zillow pulled back, and some of these other players that only have a single horse, a single pony to ride on, lending partner, and they're going in. Our strategy with Express Offers is changing the game a little bit because now all these iBuyers, including some of our members of this meetup, our requirement for an iBuyer is somebody that's doing 50 plus transactions a year, and they have to have so much capital to fund additional flips to be on that program. But there's a couple investors in the Philadelphia region that raised their hand and said, I want to be on that platform because they're getting the deals served to them from all these agents that are finding these distressed properties now.
Has that trigger been pulled in the Philadelphia area?
Yes. Yeah, we're live and well. Like I said, they've already done 65 flips since February.
The last time we talked about it had not yet been pulled.
Yeah. Well, it took until February is when it opened up. Yeah. So
is that company planning on doing just Philly, or they're going to go into the suburbs?
They are their program is nationwide. So they a lot of those the 65 I talked about were Montgomery, Bucks, Chester County, Delaware County. They're
okay. So when you say Philly, you mean the region, not the actual Philadelphia.
Yeah, and they open the entire state up. So they do Pittsburgh, Harrisburg. They're looking at deals. Then we have another iBuyer on that same platform that owns over 11,000 doors. They're a landlord of single family homes. So they come in and, there's a different type of program where they're coming in and they're buying the single family house to rent it out. The world is changing.
Wow.
So the mom and pop flipper is dead.
Not yet, but beware.
Not yet, but it's coming if what you're talking about is happening. If the supply is so short and you've got two companies, one has 11,000 doors, but that's not just in this area. They're just coming into this area.
They're just coming into this area, yeah.
But they have 11,000 doors and the other just did 6,000 flips. And if they're coming into this area with that type of ability to scale,
it's going to definitely have an impact on the local, regional flippers.
Wow. And are those two, just to ask the further question, are those two companies, do they pay top dollar or they just have access to the folks that are selling, like on your platform and other relationships?
Yeah, so what we're seeing in the iBuyer program since we launched it about 2 years ago is these iBuyers that are coming on are being just as diligent on their deal analysis as us local flippers. Like they're not they're not overpaying for deals. When they go in there, they have what's called the buy box, and the buy box will define that, this iBuyer will only look at a deal at 65% of ARV, right? Or 70% ARV. So that, they'll have their terms, what kind of deals they're looking for, what the numbers need to look at. And then if it matches that criteria, it matches up that iBuyer and they'll take the deal.
So then they have better access, because your typical flipper or landlord there's not enough places for them to buy unless they're just doing huge amounts of cities and town, like they're all across the country, and that's why they can get their 6,000 or their 11,000. Because I'm thinking, like, how the hell did they get so many deals? Because there's not that many, if they're doing it across the country, well, yeah, then they could, and they have the ability to scale, then they could get to 6,000 or 11,000.
Yeah, both of these companies started on the West Coast, so they're national. They're in most of the states now, so that those projects are everywhere. But they're coming into the Northeast very strong.
Yeah. Well, they buy huge tranches of REO and distressed property.
That's right.
And they buy them at a premium. They'll wholesale some of them. They'll keep and retain a handful of.
So they're working with the lenders to buy huge tranches of the distressed properties.
The ones we see are. I mean, that I could speak to. I mean, we're in the throes at the institutional side, so we saw non-performing loans come through and who's bidding and whatnot, and it's the same thing on the property side.
Well, it's kind of a, when the savings and loan fiasco happened, there were folks in the market that were buying huge tranches of distressed debt, and so this is kind of a similar, they're buying huge tranches of distressed properties. Yeah.
That's what we're seeing. I don't think the mom and pop flipper is dead. I think real estate is local. Those local relationships with local counsel and local title and local lenders. Those guys are still going to find best in breed deals, niche deals, their neighborhoods. Continue to be able to scale their business.
I agree with you, Ryan. The local stuff. The deals are still going to be found.
Yeah,
local is everywhere. Yeah, everywhere is local.
Right, but I guess the flippers that we fund tend to have a geographical footprint, right? A neighborhood they know really well, or a handful of neighborhoods they stay in: Fishtown, Brewerytown, Norristown, Pottsville, right? And so those guys, I think, are still going to maintain. Those institutional buyers are going to big REO auction platforms and institutional debt, and they're buying, and so they may get a handful of properties in those concentrated areas, but they're going to have a ton of assets across the whole state of Pennsylvania when they come into PA, not just hyper local markets. My opinion.
We'll see how this unfolds.
Yeah.
I think it all depends on where the seller or what visibility the seller has to the market that they want to sell to, if that's the right way of putting it, right? If a seller is smart and well, not necessarily smart, but if they connect with a real estate agent who ends up putting their property on the MLS, once it hits the MLS, it's public and everybody can get to it. The trick of the local flipper, and every place is local, as you said, Ryan, is for the flipper to know their neighborhood and to be able to get to that seller before that seller contacts anybody else. That's the trick.
I have a question on that.
But it sounds like, I'm sorry, go ahead, Mike.
Oh, sorry. What is the actual process for Zillow acquiring properties? Are they like advertising? Somebody looks up somebody that has a house, instead of, I have my own marketing. A lot of flippers have their own marketing. That same person may be going to Zillow. Are they reaching out? If you have in so many words, if you have a distressed property or you need to sell, contact us just like we do?
Well, Zillow, of course, pulls everything off off Bright MLS, right?
Right.
So if it's on the MLS, it's on Zillow.
But as far as for a potential seller, one of the first things they're going to do is look, what's my house worth, right? Is there going to be some kind of way that Zillow can identify them, or how are they finding sellers? Is it just through agents right now?
If it's on the MLS, Zillow knows about it.
So it's just it's properties that are just on the MLS right now.
To the best of my knowledge.
Zillow has, my house is on Zillow, Don. I'm not on the MLS.
But
No, I'm talking about for distressed properties. That's what
Zillow has the inventory of all houses.
But somebody posts it on Zillow, correct?
So they're only going for properties that are on the market per se, not off market.
I don't know about that. I really don't know about that, because like my wife said, oh my God, you see what our house just went up a little bit. So she's on Zillow looking at that Zestimate, Holly. God forbid, I'm like giving her education.
Well, it sounds like Holly is saying they're going out to realtors and saying, hey, we want you looking for properties for us.
Yep.
Yeah, so it's a combination of them going to realtors, but they also, going back to the data and the technology, they have all the data. So they know that this zip code or this house was on their website getting a Zestimate, right? They know that data, and they can conveniently put a message on that same screen that, hey, if you'd like to sell this house, we have a buyer for you.
Mm.
Yeah.
Right? It's all about the data, guys. They have all the properties. Your house is in there, Don. Everybody's house is on Zillow.
Yeah.
Everything in public records is on Zillow, and they basically have an algorithm that says high likelihood to sell, likely to sell, medium to sell, so they have a record of where you are, and that's how they're going after them. So I don't think the only stuff that they have on Zillow that is like active on the market, they pull from MLSs, yes. Yeah. But they also have all the off-market stuff as well.
Yeah.
So are they going, Holly, do you know, because this is interesting. So given that they have these algorithms that say, these folks are likely to put their house on the market,
we have those algorithms too. They're built into it's a program that comes with the MLS. So we have those algorithms too. Like Richard and myself, we can market to those sellers as well.
Yeah.
Yeah.
But are you talking about using those algorithms for folks that have not yet decided to sell their house?
Yeah.
Actually contact them?
Yes.
Okay. Yeah. Yeah.
Yeah, absolutely.
Yeah. The thing that is interesting, that's obviously very interesting, but the thing that it also interests with regard to your iBuyers, Smarty, and the fact that these large folks have the ability to scale, they can go to the banks and the lenders and say, we will purchase all your defaulted debt. We will purchase the properties that relate to all your defaults. And any bank or lender, that is going to look appetizing to them, because then they don't have to go through the process of dealing with their defaults. If they have one party that they can say anything that is in default and we are not going to spend the time to negotiate or whatever, we know we can send it to this, company, whatever it is, that is very appetizing to banks. And then that takes a whole segment of distressed debt out of the market because they
Ryan was saying, Ryan, you were saying that you're seeing the big movements, Ryan, where they're going right to the bank and
yeah.
get a big block of REOs and boom, we'll take it
Right,
off.
but it's not just nationwide. Like Ryan was talking about these I thought, Ryan, maybe I misunderstood you. I thought you were talking about this, nationwide distressed portfolios. But you can actually target the banks in each town, in each region, like the Philadelphia and surrounding region. We're going to go to the biggest banks that lend here and just take all their distressed properties by partnering with them. And then that, again, that hurts the small flippers, because a lot of times the small flippers are getting those properties because they're in default.
Yeah, but that's accurate. You know what I mean? I would say the big iBuyers are probably not going to the local Meridian Bank or the First Colonials yet, but that may be the next avenue, for them.
Right.
Yeah, and Rich,
It's a good deal for them too. They can get a whole bunch of properties in one region, the iBuyers. I mean, think about it. They'll scale in that region and just get all the distress. I mean, if it were me, that's what I would do. So
leverage. You go into the money makers in the market, and we'll take all the things off your books.
Right, and then you scale in that region, and you got a operation in that region. So I got to believe they're thinking that's what we're going to do. Remember, we were not in a downturn, so they had to do national portfolios. If we are now going to go into a downturn because of what's happening with COVID and employment and whatever, there probably wasn't enough of that stuff in any one region to satisfy their needs because they were big guys. But if we go into a downturn, I've seen 2 or 3 downturns already, and I see what happens. But if we go into a downturn because of COVID and unemployment and et cetera, and now there's enough to satisfy their need in a region, why wouldn't they go and say, we'll take everything you got?
Yeah, so Redwin and John are making some comments about keep their day job and are we going out? I would say, and Rich made the comment, relationships and pocket listings and stuff are still going to be in play at the local level. So it's only going to hit those banks that would go to the iBuyer to take things off the books.
Right.
If the bank already intervened with that homeowner. So if there's other situations in investing where you can find homeowners that need to sell, they're motivated to sell, they're going through a divorce, they're leaving and the house isn't up, they can't put it on the market, they don't have the capital to fix it up. But the avenues of finding those motivated sellers are going to start getting smaller and smaller. Going to the pre-foreclosures before they're foreclosed, and then developing that relationship is going to be the way to survive.
And I would say that the big banks, those big iBuyers are going to deal with the bigger lenders. They're not going to deal with the smaller lenders because doesn't make sense to deal with the smaller lenders. So there'll still be opportunities to get distressed properties that have mortgages with the smaller lenders.
Beth, I think you're exactly right. I think the iBuyers, as they're calling them, want to work with sources of distressed properties for which there are many at one crack.
Right.
The onesie twosie deals, it would be hard for me to imagine that the iBuyer category of company would want to deal with what I call the onesie twosie a distressed property. So like Rich said, it's all about relationships and pocket listings. I'll give you a concrete example of a situation that happened to me maybe 6 or 9 months ago. One of our borrowers ended up buying a property that was let's see if I can get the story straight. A family went to a funeral home to make arrangements for the death of the father, I think. And the secretary of the funeral director happened to be sitting in the room when this meeting took place. And the son of the deceased said to the funeral director, "What do I do with my father's house?" And the secretary contacted her sister, who happened to be a real estate agent, who then contacted a flipper, and the flipper made an offer to the son of the deceased and made the deal. I ended up funding that. So, that's the kind of stuff that does happen. Now, can you build 100 flips a year on that kind of a scenario? Not likely. But as Rich said, it's all about relationships. It is all about relationships.
And Holly made a good comment. There's always enough to go around. The big guys, even if they come in, there's still going to be, it's about building those relationships and getting your word out in your local turf. Know the turf.
Bryan, you talk to Wall Street every day. What are you seeing? Not maybe in terms of flips, but in terms of how the street or some of these larger aggregators would look at this.
Yeah, I mean, I see that people have been trying to do the institutional side for, to try and do large things in real estate for forever. And it always seems to revert itself back to, I think it's just the way that it's run at the county level. It's run, there's a lot of uniqueness, and to be able to take something, you can take a swath of anything and create, a boilerplate template and go execute on that. But where people are going to really add values when they take something from 1 unit and make it 2 units, or they take 2 units and make it 1 unit. And so that's what I continue to see is kind of, when we talk to people, is there's an element of taking things up to a national level, but it on certain kind of slivers of things. So maybe all the blue houses are going to be great for us to manage, but then when you start introducing all the variables, it's very difficult for it to you lose your economies of scale. And so that's what they continue. So that's why they work with originators like us that know the markets well. We know the geographies well. We know the nuances of what it takes to build new construction in our market versus somebody that's just doing a fix and flip. So,
So I think in general, what we see is Wall Street, some of the big players aren't going to be able to mobilize at a local level. So Beth, to your point, local banks are still going to have deal for local flippers, pocket listings. The example that Don gave where, your local real estate investor does 4 or 5 of these deals, and that happened to be one of the deals he does this year. Those deals are going to exist. If you continue to focus on your business, your core business of what's essential, which is finding new deals and executing on those new deals, I think there's going to be plenty, to Holly's point, to go around for everybody, for the lenders, for the borrowers, for the flippers.
Yep.
So my message is make friends with your local funeral parlor director.
As long as you're not buying a casket. Yeah.
You never know when you're going to need them, right?
Yep.
right.
It's a great story, Don.
It's a true story, 100% true.
Yep. That's good.
And on a high note.
Yep. Well, this has been fantastic, guys. We're coming up a little after 8 now, so we typically end around this time. So, any other questions out there? I'm looking in the chat. You see any other one, Don? Small time flippers, comments. I think we're good. So, yeah, I want a big thanks to Don, we didn't actually let you say a few words on your side on the private. Do you want to add anything at the very end here from your perspective of lending?
I think it's after 8 o'clock. I think it's cocktail time.
Okay.
So all I can say is if like Brian and Ryan, we do everything we can to help our borrowers make money. We work very closely with them, very hands-on. We go through the properties, we evaluate the numbers, we help find contractors, we help work with the contractor to make sure the contract with the contractor is correct, and so on and so forth. So if we can help you in some fashion, please feel free to reach out. And you can either reach out through Smarty or go to our website, which is fundingthe4flippers.com.
Very good. Well, Ryan and Brian, thank you for a great presentation and some insights for us investors here on the phone. I think it was very valuable. And everybody be safe, wash their hands. Ryan, I'll hook up with you next week down the shore, and you better get ready to have a few chili pops with me.
We'll have a couple pops. We'll be ready.
Are we all invited down the shore?
Absolutely.
Yeah.
Make it a party. Let's do it.
Ryan.
Woo-hoo.
Come
What's the
on.
address?
Distance. Wear your mask.
Right.
Right.
So everybody have a great night. Thanks for your attendance. And as always, everybody in the group, you have my email, and up on the Meetup, offer up topics and ideas of what you want to see as we're lining up. Sam and Don and I are coming up with our second half of 2020's agenda. And we want to make sure we have some great topics that are relevant for all of us. And as you can see, our theme the last 2 months, all of the topics have been around COVID, obviously, and we want to keep that very relevant to the market and the timing that we're in our investment business. So thank you, and have a good night.
Thanks, guys. Thanks, Don. Thanks, Sam. Thanks.
Thank you.
Thanks, Brian, Ryan, Smarty. Good night.
Good night.